Hi, Sarah. Thanks for having me. Yes, we are predicting a recession, but I think, the fine print is important. The recession is predicted for late 2023, so Q4 of next year, and, Q1 of 2024. If you look at that sort of relative to a typical, Fed hiking cycle, that's a little bit earlier than what I would say is the average, which is about 2 years out. So I would argue that it's still quite a ways off. And if you think about how equities did, prior to a recession, I mean, they sort of peaked, 3, 4, 5 months before. So I would argue, we are definitely late cycle. The end of the cycle, which is the recession, will definitely happen one day, but it's still a ways off. I would put, where we are in the markets and this side of reversal, basically, we are in the fourth month now of basically the pullback from the first trading day of the year. So there's plenty of negativity. There's plenty to, sort of worry about. But I would argue that, that we will recover from this pullback. This is a pullback. We sort of had this, three drivers of this big pullback. First, it was tech and mega cap growth and their earnings. We are approaching earnings season starting tomorrow, so that's a cause for concern. Then we had Russia, Ukraine, which sort of played out, I would say, very much in line with the historical playbook, down 3 weeks, 7.5%, and recovered pretty quickly. So now it's, primarily basically about the cycle, about the Fed, and I would argue it's too early to worry about the recession right
Too early to sell. So what part of the market, Binky, in particular, if you think that we are going to come back on firmer footing here, but you've got a lot to pick from when it comes to the damage that's been done.
Absolutely. So I would argue, today's concern, is really the Fed and the recession. I would say, it's only worth basically since the recent peak, worth about 5%, despite, how much we talk about the Fed and inflation. And I would argue if our baseline is right, that a recession is still some ways off, then, you're going to basically, see a lift basically in the cyclical parts. And I would argue, especially the financials, we're still long energy. If you look at what the financials are pricing in, it's a 10-year of about 1.5%. I mean, in some sense, they're sort of pricing in the 3 years down the road cut in interest rates that the bond market is pricing, which is a recession, basically. So I remain long energy, cyclical. Financials, cyclical exposure, yes.